I want to welcome everyone to the Washington National Tax Roundtable's Tax Leadership Symposium program this afternoon. This is a global broadcast, so it's going to be different times. There are going to be some people and still morning time, obviously, on the West Coast, and other people late in the evening in Ahmedabad. And I want to appreciate everyone. It's with our gratitude for the giving of your time to all the attendees this afternoon. And a special thanks to our sponsors and our panelists, Infinity Globus, Tri-Merit, SegStream, Sparse Technologies, and Veritax Advisors. Our first panelist is the highly renowned Allan Koltin of the Koltin Consulting Group. And he's going to be discussing a lot of the trends affecting the accounting profession, including the Great Resignation, the Great Consolidation, and of course, the state of the profession with all the numerous PE investment opportunities that we've seen over the last few years and continue to accelerate. Welcome, absolute honor and privilege. Thank you.
Peter, thank you for having me, and the entire group. It's a pleasure to be here. I could sum up what I'm going to talk to you about in the next 20 minutes in one word, and that would be insanity. If you said you wanted a better definition, I would say never seen before. And if I had to expand that, I would say every day is a new surprise. This profession started back in 1887, I think before any of us, except me and Randy, were born. And I would dare say that in the last 2.5 years, more change, more transformation than maybe all the years combined. For those of us that have been in this profession for 10, 20, 30, 40 years, tax reform acts were change, recessions were change, the demise of Arthur Andersen in this industry, change, the prior industry, Leventhal and Horwath. But if I just think about transformation, technology, talent, capital, disruption, I just think there's been more of it in the last 2.5 years, and it's every day is something new. So let's start big and let's work our way down. I'm going to start first just because it's maybe the sexiest. It's the M&A frenzy. It's private equity. It's things we never thought we would see before. And obviously, you don't have to go farther than the big four accounting firms. Now, while there's some friendly jockeying for position going on amongst them, trust me, most, if not all of them, if we were to look at the end of 2023, I don't think we'd have to go much further than that. My belief, and I think it's shared by many, including individuals in those organizations, they will look radically different than they do today. Alternative practice structure, the separation of audit, and we'll say everything else, but let's call it tax and consulting. I think that's what it's going to look like at the big four. My gut is the audit firm will keep the brand. Tax and consulting will go the way of private equity or an IPO. And if I was to expand beyond the big four to the top 25, I would offer up that if we had a reunion call at 12/31/23, about 15.5 months from today, the majority, and what I mean by majority is 67 to 75% of the largest firms in America will be partially or majority PE owned. Now, that may get to a question. The question is why? Well, I would tell you that what got us to the dance won't keep us at the dance. The thirst for capital, the need for capital to rebuild the business as the business continues to move from a compliance provider to a value-add provider, that being consulting, advisory, outsourced type services, is what's pushing a lot of this. I also believe the reason we moved to private equity, that they're so in love with us after not being in love with us for, 25, 30 years, is they love our stickiness with our clients. They love our positive cash flow. They'll never say it publicly, but they think we're poorly run because we're a partnership and every partner has a say. I think they think there's a low risk of liability and we do really good work. Clearly, the alternative practice structure, which has been in place for 25 years, is working. And I think they see an undervalued business, quite candidly. When we retire, most of us get 1 or 2 times our compensation as ordinary income, 10 years, right? Well, they come in with valuations where you're getting 7 times, 8 times, 10 times, 12 times. I've seen one 15 times earnings. Rather than get it all on the backside, you get it up front. And more importantly is you get a strategic and capital partner. Now, I'd love to tell you that private equity, and I think if we sort of stop and think about who's out there, so everybody talks about Eisner, which was the first, Shellman, which was the second, Citrin Cooperman, the third, Cherry Beckert, the fourth. But truth be known, if we really are talking tax and audit, the first one was really Ryan, a tax-only firm in October of 2018. They've already gone through what we call the second bite of the apple, where a new PE group has come in. I'm trying to remember exactly. I think they're about 450 million of revenue at the time. Today they're about 610 million, and the valuation of that business has more than doubled. I'm seeing in the marketplace already today private equity coming in, not just chasing the top 25 firms, they're now chasing the top 200 firms. And I think if we look at this, it's going to be radically, radically different. One of the reasons outside of the transformation of the business and the need for the next generation of technology has to do with talent. And I'll share with you a meeting. I was sitting in with one of the PE-owned firms last week in a meeting when they were talking to a very large regional firm, about an $80 million firm, about joining. And this is what the 30-something, maybe even 40-year-old partner of that PE-owned firm said. He said, it goes like this. He said, Allan, meaning me, he said, your generation, people in their 50s and 60s and now retired, when you retired, you thought you won the lottery because you got 1 or 2 times your compensation spread out over 10 years as ordinary income. He said, look at me. He says, I'm 40 years old. If you think I'm going to sit here for 25 years grinding the same stuff over and over to get that, 1 or 2 times my comp as ordinary income, it's not going to happen. He said, here's why this is great for the young ones. We were hoping the old ones would buy in. I'm going to get a check with capital gain treatment immediately. If we can hit some EBITDA hurdles, I'm going to get another check in the next 2, 3, 4 years. And we have rollover equity, just like the PE group. We're going to get a bite of the apple and we can pull it out or we can roll it over into the next fund. And I think what's happened is this thing called the unfunded chain letter is getting disrupted. In a PE deal, all of the deferred comp, all of the capital is essentially returned. And more importantly, I think if you get into the heads of the 20 and 30-year-olds, they're not built like the 50 and 60-year-olds. They're not taking one job and staying at a job for 40 years. They're going to have a lot of jobs, a lot of career opportunities. And, as that 40-year-old basically said to me, he said, Allan, you know what? In 5 years, if I want to go do something different with my life at 45, I've unlocked my goodwill value. I realize I probably have a non-compete, so I'm not going to stay in public accounting, but I can go do something else with my life and maybe do that something else 2 or 3 more times. So this is something that's not going away. It's here to stay. Now, some of the firms have said we're not going to go the way of private equity, and they've combined forces. Probably the biggest one to do it today, sitting at the 8th largest position in the country, is a newly created firm called Forvis. That's VKD, who was 750 million, combining with Dixon Hughes, who was 500 million. That's another way to do it. Combining forces, having more capital, the ability to invest deeper is the way of the world. But I think we're going to be looking at a whole new game. When I've been consulting with firms on M&A specifically, we've been talking about the deal that we've given, the deal that we have internally. If we want to stay relevant in M&A, it's going to have to change. The bottom line is, if you want to remain an independent firm and play in the M&A frenzy, you're going to have to open a checking account. And for sure, if you're going to transform the firm and get into consulting and advisory services, those companies already demand cash as a currency. So the times are changing, not just the need for technology, not just the challenges of staffing. I mean, my God, every statistic you read, accounting graduates is down year after year. Accounting graduates that would take the CPA exam is down 10%. I don't get that. Why would you go through that torture for all those years and not get the reward? Well, the answer is A, they don't think it's a reward, and B, this is not their permanent resting place. It's just a place that they're going to use today to better themselves, to make themselves more valuable, and they may stay or not stay in public accounting. You know what nobody really talks that much about, and I think it's the biggest spike. One could argue the biggest spike is what percentage of your people come back to the office. And it's always fascinating because culture dictates a little bit here. I do find, generically speaking, the bigger the market, the more public transportation, the longer commute, the less probability people are coming back. And there's been a great debate that's been coming up. I months ago said, how do you train and grow a kid from the bedroom? And buyer beware, because I think in 3-4 years, we're going to have a major training deficiency. It doesn't show up yet today. What does show up yet today is by not having people in an office, the stickiness, the culture, the connectivity isn't what it is. People are more apt to leave and go elsewhere. But in fairness, I've heard some counter opinions to that. And look, it's a trend where nobody has the exact or perfect answer. Some are saying on this training issue, no, we don't accept that they're not going to be trained. We just have to find different ways to train our people. Those would say, hey, what you're saying is if they're physically in the office, you're going to get on a call and you're going to call them in the office and you're going to say, I want you just to sit and listen on this call. Or if you're in the office, hey, last minute, I'm going out on a pitch to a client or a prospect, come with me. I'm not sure how often that actually happens, but those are the things we hear about, the ability to collaborate, to innovate, to come up with new ideas, to do what we call spot training. When it's a remote world, it's not there. And what they would say is, hey, you just have to have it a little more structured. You have to have it a little more planned out. So great debate on the long-term impact of people not being in the office. Also, the issue of culture. Everybody says the culture is going by the wayside because nobody's here. The question is, virtual companies existed before the accounting profession, but they have found a way to build, to maintain, and grow culture. Is it just that we're using an outdated playbook? Do we need to look at this world of talent differently? But going back to the big spikes, here's the 2 big spikes I'm seeing, and they all have to do with talent. One is offshoring, right shoring, call it what you want, an alternative workforce that we don't have, that we literally can have overnight. And yes, economically, it's wonderful. Work that we do at $125 an hour maybe gets done at $25 an hour and up the food chain. But here's what I would tell you. The superstars who are leaving, who are part of that great resignation that Peter talked about, if you give them the mundane and you ask them to sit quietly and do it, the average workers will do it. They'll sit there, just pay them a fair wage and, respect them, and they'll stay there. But the superstars, they're out of here. As one 28-year-old tax superstar at a regional firm said to me, they said, Mr. Koltin, by the time I did my 15th tax return, I knew how to do it. If you think I'm going to sit here over my career and do 1,500 of them, you're out of your mind. So the great ones, if you give them that mundane work, they're gonna bolt. Now, I don't want to paint offshoring as mundane. I mean, I look at these firms that are doing it, and you know what? They talk about best and brightest. I think a lot of the people they put on the accounts are better than our own. In fact, I'll go on a limb and say they are. And it's not just to do the lowest level. I'm watching firms advance, and instead of using staff to do pure compliance, rudimentary work, I'm now seeing senior supervisors, managers, and they're part of the engagement team. And the crazy thing is, the client doesn't care. The client just cares, like, do you understand my business? Can you get the work done? Can you get it done on time? If we have problems, can you solve them? Can you do it at a fair price? And maybe can you show me a little love? This is a relationship business. That is a major, major change. I think another change, and I don't think many firms are onto it, it's the investment in recruiting talent. I can't tell you how many times I say, what are you doing? And they tell me, and it's no disrespect to LinkedIn or other social media companies. We're a big spender. But if everybody's just doing the same thing the same way over and over, you're going to get the same results. You're probably going to get less results. What I'm seeing is a new way to look at talent that I've never seen before. We all live in hierarchies. And old school public accounting, the hierarchy was there's three things that matter, right? Billable time, right? Hoard work, bill as much as you can, book a business, don't transfer that book, hold on to it, and new business origination. And in today's world, there's just so many more new metrics. When we go outside the accounting profession to the investment banking and financial services and private equity group, you know what they talk about? They don't talk about origination. They don't talk about billable hours. They don't talk about books managed. You know what they talk about? What's the single most valuable thing you can do? Steal a star from another firm. And I look at our recruiting strategies. You know, I work with firms. I would say the operation is successful. The patient died. The firm is $50 million and they've got one full-time talent acquisition scout that on Monday goes after kids on a college campus. On Tuesday goes after somebody that's been in a big four accounting firm for a year. On Wednesday, they try to get a lateral senior manager, and Thursday they go for a partner. You talk about not enough resources thrown at something. I mean, I would think a firm that size not only has 5 to 10 full-time talent acquisition scouts, they're pouring millions of dollars into building the recruiting brand, taking everything we do that's great and having a database of thousands of people and reaching out to those people and working it just like we work industry specialization. But there's still too much old school thinking, too much old school recruiting going on. And look, at the end of the day, if you dummy this thing down, you got to get stars if you're going to stay to be a high performing firm, right? So how do you get and keep a star? You got to be growing exponentially because they want to grow their career. They're not looking at some apprenticeship for 10 to 12 years. Number two, guess what? You got to pay them a lot of money. So you better have a culture and accountability and a governance that produces a high profit firm. Why? Because some of those dollars we got to spend back in the business to build out the firm of the future, but we also have to pay the highest wages we can to stay competitive. Growth firm, high profitability, rapid move throughout. And the fourth one is a culture where I can live my life and still thrive in the business of public accounting. So many challenges, but so many opportunities out there. I intentionally didn't use the word threat. I talked about technology. I talked about transformation. I talked about talent. The fourth T is threat. Why do I say that? Because if I've learned one thing in 40 years and over 100,000 hours servicing the accounting profession, change only happens in our profession when the change itself is deemed to be greater than the status quo. And right now, the status quo is pretty good. Many firms, 2020, best year ever. Hey, take 15 years of revenue, put it into 12. Don't spend money. If you couldn't make money in 2020, you need to go find a different occupation. 2021, we took the 2020 playbook and we tweaked it, right? And we did even better. And as financial results are coming in for the 9 months ended so far for 2023, it looks like we're going to have a third back-to-back year of record profitability. You go talk to a group of partners about transformation and change when you're coming off 3 national championships. Good luck with that. So I worry about the firms that the feeding at the trough is so good today, they can't see the transformation of what's happening within our business. You know, a question that always comes up, they say, hey, Allan, if so many firms are going the way of private equity, there's only so many firms, who's the end buyer going to be? I would tell you the end buyer, we don't even know who it is. You know, Elon Musk today is talking about buying Twitter. I don't know, someday he's not buying an accounting firm, or he's not buying a piece of an accounting firm, maybe the tax and consulting side. I think the ultimate buyers, as we look 3, 5, 7 years, might in fact be radically different than even what we're thinking today. One thing is for sure, this profession is going through change. You need to get your partners sitting around the table and talk about it and say, what do we need to be doing different? Not band-aids, substantially different than we're doing today. If we're going to win the war on talent, if we're going to win the war on what clients want and need, if we're going to win the war on this thing I call the balance between innovation, investing for tomorrow in a better today, and short-term profitability. That's it for me, Pete. I was just the warm-up act. The next speaker, that's the best in class. That's why I'm here today. Thank you.
Thank you, Allan. Really appreciate it. It's always an incredibly insightful dialogue. Any bold predictions going into the end of this year, into next year?
Oh, you're good, Pete. You're good. You know, the engagement letter didn't say you were going to ask that. Yeah, so we're going to have 2 more top 100 firms going the way of private equity. And I'm going to give you even a bolder prediction. And that's going to make, what do we got today? We've got 4 or 5, so that'll get us up to 7. And next year, we're going to have twice that number. 70% of the top 25 PE owned by the end of next year. Thank you.
Amazing. Amazing. Thank you, Allan.
Thanks.
Our next panelist, Randy Crabtree, the co-founder of Tri-Merit. Randy, a very warm welcome. Thank you. Randy is going to be discussing the Inflation Reduction Act of 2022 on specialty tax incentives. Thank you, Randy.
Thank you, Peter. So I got one question. Last week, I had to speak after Ron Baker. Today, I have to speak after Allan Koltin. How is this bar getting set so high that I can't even reach that I can't even see to that level? This is just not fair. But Allan is always a thrill to listen to. I mean, the things he say and the predictions, like Peter just asked, the predictions he makes, they always come true. I mean, I need him to, go help me buy lottery tickets or something. He just knows what's going on everywhere. And one thing I want to point out that Allan didn't say is I'm going to promote Allan for a second. I don't know if he wants me to or not, but he has a conference coming up the beginning of November, 1st and 2nd. I think there's still a handful of slots open, Winning Ways in Rosemont in Illinois. And you're going to be able to hear him talk about private equity, and you're going to be able to hear Gary Seamus and him have a debate back and forth on it. I would not miss that for the world. Right, Allan?
Thank you, Randy. I appreciate it. If you sign up, tell them you know Randy, and your price will double. Thank you.
All right. Well, Peter, thanks again. I've known you've been doing this for a while, and I really appreciate you inviting me to be part of this today. I am going to go through a few slides. What I want to talk about today is kind of wrapped around tax advisory. Things Allan was saying is you have to, there's things you're going to have to do to compete. There's a lot of money coming into this industry. I really feel an important aspect for tax preparers in general is the tax advisory end of things, but I also think a niche expertise is going to be very valuable as we go forward in this industry, because as Allan says, this industry is not static. It is rapidly changing. And so what I try to do is just talk about ways that we as providers of tax services can help our clients. So we're going to talk a little bit about there's me. Don't worry about that. I do a lot of speaking. That's my bottom line. Tri-Merit, we deal with R&D, COSSEG, WOTC, 170D, 45L, all different credits and incentives. The one brag I am going to give is we were recently 2 months ago named to Inc. magazine's fastest growing private companies in the US. And I'm pretty proud of that, but that's really from the people we work with and the people who work with us. All right, so let's talk Inflation Reduction Act. Obviously, one of the two major bills that came out recently, the CHIPS bill being another one. But let's talk about the end of year planning opportunities we have through changes that occurred in the Inflation Reduction Act. I'm going to probably start calling it IRA. It's a terrible name because every time you say IRA, you think of something different. You don't think Inflation Reduction Act. But today, when I say IRA, let's think Inflation Reduction Act. So first thing, there's many things in the IRA. We can't go over all of them in the next 20 minutes. And so let's go over three things that really are affected in the IRA that is going to have some significant impact to taxpayers going forward. A lot of it, most of it, if not all of it, positive. But the first one is 179D. 179D is the energy efficient commercial building deduction. And so who can benefit from 179D? Traditionally, before the IRA, commercial building owners and designers of government buildings. Designers of government buildings can get this deduction allocated to them from the government entity because government entities are not tax-paying entities, and therefore to keep this incentive out there for more than just for-profit building owners, they're allowed to allocate this deduction to designers. That was historically, starting next year, what the IRA has done is allowed tax-exempt entities to also allocate this deduction to the designer of a building. Architect, engineer, general contractor, mechanical contractor, maybe an energy consultant business that's designing a building for energy efficiency. Those can be allocated starting in 23 from tax-exempt entities. This is a permanent part of the tax code, never was until the end of 2020. So from a tax planning standpoint, from a tax advisory standpoint, we know this exists. We know this will continue to exist. Obviously, any tax code, tax law can change whenever the next Congress comes around, or the next, new thing comes around. But I don't expect this to change for a while. So this is a permanent part of the tax code. This is available on buildings, again, commercial buildings, government buildings, starting in 23, tax-exempt buildings that have something done to them. A purchase is not enough. You have to build it from the ground up, or you have to remodel, addition, enlargement, retrofit, some kind of improvement to the building or new construction. And what it is, and I'm going through this fast. Hopefully I remember what time I got till, but we'll play it by ear here. What this is accelerated depreciation. It's really for the commercial building owner. It is taking a deduction that I would have got over the next 39 years and accelerating a portion of it to today. Now, what I'm going to say is with the commercial building owner, you can actually look at any $31.15 change of accounting method. So commercial building owner, long way in the past we can look at, get it allocated from a government entity or a tax exempt building. That has to be taken in the year that the building was placed in service. So that's just two different ways we can use this. Accelerated depreciation for the commercial building owner. What it is currently through the year 2022 is $1.88 a square foot deduction. If I can show that my building is 50% more energy efficient than a hypothetical version of my building would have been at some point in the past. And that point in the past changes based on the year that I'm analyzing. But let's assume that I meet these requirements. I get 50% reduction in energy usage. Again, just computer modeling. I don't look at invoices. I don't look at, electric bills or heating bills. I just computer model this building. If it's 50% more energy efficient, I get $1.88 in the year 2022, $1.88 a square foot deduction, accelerated from 39 years to 1 year. If under the current rules, if I don't meet the 50% reduction, I can get a portion of the deduction if I meet the requirements listed on the bottom of the slide: HVAC 15% reduction, lighting 25%, building envelope 10% reduction. I can get 60 cents a square foot for each of those that I meet. But if I meet the 50, I get the whole dollar. Again, in 2022, $1.88 a square foot deduction. So it's a nice benefit. I'm accelerating this deduction from 39 years. Now, government building allocation, or starting next year, tax exempt building allocation to the designer, that's not accelerated depreciation. That's basically a free deduction. And we'll talk about the benefit of that in a second. All right, that's the history of 179D. The changes in the IRA, besides the tax exempt entities, are pretty significant. That's one significant. We've wanted this tax exempt entities to be able to allocate this for a long time. And now it just came through. But the other changes are really significant. We're going to go as high now as $5 a square foot deduction starting the year 2023. From $1.88 today to potentially $5 a square foot deduction in 2023. So if you or you're a tax preparer, any of your clients are in these categories, commercial building owner or designer of government or tax exempt entities, this is something you need to look at because the benefits could be tremendous. The way you qualify changes in 2023, it's no longer a 50% reduction, and now as little as a 25% reduction in energy usage starts you qualifying, and that starts at $2.50 a square foot. If you get up to 50% energy reduction, you get up to the $5 per square foot. To get those max dollars, you have to also meet something that was defined in the IRA. Well, the definition was out there: prevailing wages and apprenticeship rules. That's been out there, but you have to have individuals working on this project that are being paid prevailing wages and have apprenticeships in part of it. I'm not going to go deep into that definition. One, because IRS hasn't made a complete clarification. And two, you can do a Google search and look up prevailing wages and find out what IRS is saying about that. But if you meet those requirements, and now we're going to go as high as $5 a square foot. So just put this into, and again, we're going through this fast, but just to put this in real life, what does this mean? Through the year 22, we're going to go with the example, $1.80 a square foot. It's easier math than $1.88, although $1.88 is fine too. But $1.80 a square foot deduction, let's assume we have a 100,000 square foot building. We meet the 50% reduction rules. We get the $1.80 a square foot deduction. In this scenario, that's a $180,000 deduction. Assuming a 37% tax bracket, that saves, what is it, $66,000 of income tax for that commercial building owner. Now, if I'm the designer of that government building, that's not accelerated depreciation to me. In this same scenario, that deduction is $66,000 of money that's going back into my business that I didn't have yesterday before you as the tax advisor brought this opportunity to me. So it's a very nice benefit for that designer. That's $66,000 that you basically just pulled out of the air and said, hey, you already did this work. We should go see if it qualifies for 179D. It does. Let's get this allocated to you. Boom, here's $66,000 in this scenario. It's a very nice benefit that is hidden often from a lot of taxpayers. Now, it was very nice. 2023 is going through the roof if you qualify. Same scenario, we meet the minimum reduction, 25%. That $66,000 of tax savings turns into $92,000 of tax savings just based on the $2.50 a square foot. If we meet the $5 per square foot, that $66,000 of tax savings turns into $185,000 of tax savings. Again, that's you as the tax advisor basically just wrote it. You didn't write a check, but gave $185,000 check to your client because you identified this opportunity. Advisory is huge. Figuring out ways that you can save your taxpayer money are huge. And this is one that got a huge advancement. That was 3 huges in a row. 3, not 2, 3 huges in a row. So this was a very big change that happened in the IRA. I'm going to skip the next slide and let's talk about the second major thing that happened in the IRA. This is another energy incentive, but this incentive is again for real estate, but this is residential real estate. And so what this is 45L. It's a credit for developers. So the users of this are developers of residential property. This has never been permanent part of the tax code. It was also defined in 2005. It's still not a permanent part of the tax code, but in the IRA, it was extended through the year 2032. So this is all but permanent at this point. In the year 2032, I think I'll be retired. So in my lifetime, this is a permanent version of the 45L. And so again, developers of residential property. The historic definition is low-rise residential property. So we live with that definition through 2022. In 23, that low-rise goes away. So it's all residential property starting in 2023. But right now in 2022 and backwards, and this could be claimed on any open tax year. So we can't go back to 2006 and carry credits forward. We have to take it in the year the property was leased or placed in service or sold, I guess. It's a $2,000 per unit credit right now. And this is tax credit. This is, I'm reducing my income tax bill with this. I'm not reducing my taxable income. I'm reducing my income tax bill. So $2,000 per unit credit is where we currently reside with the 45L. To qualify under that, somewhat similar, but it's really a different definition. It's still a 50% energy reduction consumption. We still compared to a moment in the past to see if this consumption is less today than it was a moment in the past, which is 2006 standards. If I meet these rules, I get that 2,000 per unit credit. I can also get up to $1,000 per unit credit for manufactured homes. Again, this is through 2022. Now let's see what's happened. 2023, and all these changes kick in 2023. 2023, again, extended through 32 now. The credit is going to go as high as $5,000 per unit credit. I mean, so now 2.5 times potential credit that we had before. There's no longer a height restriction. One thing I want to point out is 179D that we talked about first, that is eligible for apartment buildings 4 stories or more above ground. All different commercial buildings, government buildings, tax exempt. Something you wouldn't think was a commercial building is an apartment building 4 stories or more above ground. Under the new rules with 45L, that same property can now be eligible for a 45L and a 179D potentially. So you can possibly double dip on construction of new high-rise residential apartments. And so that's something to be keep in mind, especially if you're working with any developers. That turns into a $2,500 credit for these residential properties. If the requirements change, we're no longer comparing to some energy standards. We now have to make sure we meet one of these Energy Star requirements. Energy Star residential new construction, manufactured home program, multifamily new construction program. If we meet the requirements listed in Energy Star, and you see the Energy Star stickers when you buy a new refrigerator or whatever, you've heard of Energy Star. They put out these requirements. If we meet the Energy Star requirements for one of these 3 areas, we start the clock ticking at $2,500. We meet the requirements to get a $2,500 credit there. To get the additional $2,500, so to get a $5,000 per unit credit, which is huge. It's about the 4th or 5th huge today, which is huge. We're going with 6 of them. We need to meet one additional requirement, which is zero energy ready home program that the government puts out. If we meet those 2 requirements, and again, we have to meet the prevailing wages, at least for multifamily properties. For the other ones, we don't have to do that. We get a $5,000 per unit credit. So math is pretty easy when we're talking 5,000, when we're talking 2,000, Under the old rules, we had 50 units to qualify. That's a $100,000 credit. Under the new rules, those same 50 units qualify starting in 2023. That's a $5,000 per unit credit. You, again, as the tax advisor in this scenario, in the 2023 scenario, just put $250,000 back into your client's bank account because you identified that this opportunity was available for them. So that's exciting. The 170ID and the 45L, the changes that came around are extremely exciting. We're going to see a lot. We personally are seeing a lot of activity happen in those two areas right now, probably more so than anything else that we work on, although we work on employee retention credit, and that's still a hot topic. I won't get on my soapbox. There's a lot of misinformation on employee retention credit. So just be aware if you're hearing things that seem too good to be true, they probably are. One last thing that I want to talk about with quickly, and I think I got about 5 minutes left. One last thing I want to talk about that happened in the Inflation Reduction Act is there was a change to the R&D tax credit. Not to how you qualify, not the mechanics of calculating it, but the usage of the credit change. So before I get into that, I'm going to give you a quick definition of what R&D tax credits are and who the main users of this are. Main users of an R&D tax credit have historically been manufacturers, software developers, architects and engineers, which we talked about with 179D as well. So there's a couple opportunities if you're dealing with clients in those industries. But in reality, anybody who meets a 4-part test can qualify for the R&D tax credit. And as Allan mentioned earlier, I don't know if we were live yet or not, but I am a partner in a bar in Chicago. That bar/liquor store took an R&D tax credit in 20 and 21 because of software development, because of the pandemic, making their online store more robust, making it easier to tie in the shipping system with the FedEx system, with the inventory system, with the QBO, with the POS system, creating modules to make all those work seamlessly with the online store involves software development. And so I have a bar/liquor store that's taken an R&D tax credit, and that you probably would have never thought about that before. And so there's R&D tax credits potentially available in industries you wouldn't think of. Often it's evolved around software development. So just keep that in mind as we're talking R&D tax credits. Quick definition. You look at your projects, you look at your client projects, do they meet a 4-part test? And that 4 parts is, do we have a new or improved product, process, technique, formula, invention, or software? That's what's defined in the code. We have to have technology involved in the project, engineering, computer science, biology, chemistry, some kind of hard science. There has to be uncertainty in the project. And this is the key. The uncertainty doesn't have to be, is this even possible? Can I make a time machine? We do not have to be to that level. It can be to the level of, can I do this better, faster, cheaper, more efficient, less operations, less waste, reduce the weight of the, whatever it is, some, even if it's an existing component we're working on, some change that we're trying to see if we can do to make us maybe more efficient. If we have that, that's enough uncertainty. And then because there's uncertainty, we're going to experiment, trial and error, mathematical equations, computer modeling, evaluating different alternatives to see if we can answer that, whatever that question is we have. And if we do that, that project should qualify for the R&D tax credit. What I want to tell you is 2 things. The credit's valuable. I mean, it's about 6 to 10% of the cost involved in it. And we don't have time to go into those costs right now. The credit got a lot more user-friendly about 6 years ago when the PATH Act came out, and my timing might be off. As Allan told you earlier, I'm old. And so time doesn't mean as much anymore, or it means more, one of those two. And so I think it was about 6 years ago, these laws changed. The credit used to be affected by AMT. If you are a business that has average gross receipts of less than $50 million for the last 3 years, you can ignore AMT and you can use this credit. Huge huge benefit. Open this credit up, not to more companies, they still qualified, open this credit up to getting a current benefit for a lot more companies when the AMT exception went away. Now, here's what changed in the IRA. This was defined in the PATH Act. There's a startup rule that says you can use the credit to offset payroll taxes if you don't have any gross receipts further back than the last 5 tax years and your current year revenue is less than $5 million. You can make an election to take your credit and offset payroll taxes. Up to $250,000 of credit was the definition in the PATH Act. That's a big credit for a small company, but it still happens with a lot of tech startups, let's say, for sure. You were allowed to offset employer portion of Social Security taxes. What changed in the IRA is they increased that credit you can allocate to payroll taxes from $250,000 to $500,000. So basically doubled the amount you can potentially offset with payroll taxes, which is a huge number, again, for a $5 million company. But it happens, and we've seen it happen. To allow you to get more usability from that $500,000, they now allow you not only to offset Social Security taxes, employer portion of Social Security taxes, you can now also offset employer portion of Medicare taxes. So they increase the amount of taxes you can offset. They increase the amount of credit that can be carried to payroll taxes. And I think this is important, Peter. I'm going to take about 2 more minutes, and I think I do have about 3 minutes left. This isn't part of the IRA, but I think you've heard of this. You should be aware of it. We unfortunately, starting January 1st of 2022, R&D expenses, this has nothing to do with the R&D tax credit, R&D expenses, which are defined under Code Section 174, have to be capitalized. And if they're US-based expenses, amortized over 5 years, if they're foreign-based expenses, amortized over 15 years, this is a major impact to taxpayers who do any kind of R&D, because we've always been able to deduct these. For the last 70 years, we've been able to deduct R&D expenses. This has gone away starting January 1st of this year, 2022. Now, that being said, our hope is that this will get postponed. It was supposed to get postponed in the Build Back Better bill. Obviously, that didn't go anywhere, or it got renamed as something else, and then got pulled out of it. What we're hearing is there's a good chance that these rules will get either eliminated, probably not eliminated, but delayed another 5 years before the year's up. But I'm not trusting that. You have to right now assume that you're going to have to capitalize R&D expenses. And if we get lucky enough that Congress decides to not hurt innovative companies, this is what this will do, hopefully this will change before the year's up. All right, with that being said, I'm going to wrap up. One thing I'm going to do a quick commercial, because Allan Koltin is going to be speaking at an event we're holding at November 30th and December 1st. So if you want to get more information on that, you can go to our website, try-merit.com. I appreciate, Peter, you having me here. I want to thank everybody for your attention. If there are any questions, Peter, you can let me know. Otherwise, I will hand it off to the next.
Randy, absolute pleasure. Thanks very kindly for your insightful broadcast. We have some questions here in the chat. I know one was, can they get a hold of your slide deck? And if you're comfortable with that, can we make it available for all the participants on today's program?
Oh, I'm an open book. I'll share anything with anybody. So Peter, I'll send this to you and you can distribute it. Is that how it would work?
Yeah, it's perfectly fine. The other question we have is, does the 179D work on new construction or only on existing properties that do energy efficient projects?
Nope, it's new construction as well. It's just not purchases. You can't purchase a property and have it qualified, but you can qualify new construction as well. Yes.
Okay, fantastic. Greatly appreciate it. We're going to move the program forward now, talking about the digital transformation, if you will, within that specialty tax incentives space. And this has been going on in recent years, and it keeps gaining additional speed on a larger scale using end-to-end software solutions. Many of them are powered by artificial intelligence and machine learning. And a lot of the users are doing this to mitigate risk, right? It's a risk mitigation protocol procedure, as well as an opportunity, needless to say, to optimize scales of operating efficiency. You know, if we think about how the profession has evolved over the decades, as Allan mentioned, and you think about how the tax function started getting automated going back to the 1980s and 1990s, right? Can you imagine thinking about preparing a tax return on paper with a pencil using tax tables and depreciation guides? That's pretty archaic. You're seeing this now transform into niche areas, how to identify, gather, and document from, let's say, an international standpoint, transfer pricing studies. Within the United States, on the US federal credits and incentive side, you're seeing how we can identify, gather, and document cost segregation studies, R&D credit studies, employee retention tax credit claims, and so much more. And it's our honor and privilege to have Richard on, who is the founder and head of product at SegStream. Richard, absolute pleasure, and thank you for joining us.
Thank you, Peter. Thanks for having me. There's a couple of things I'd like to say about what Randy and Allan said, just to kind of tie things together. The first thing is, I think Randy should be nominated for CFO of the Year of a bar/liquor store. I can't think of a more advantageous tax strategy for a bar/liquor store. So that's apropos, kudos to you, Randy. The other thing I want to say is that, the things that Allan touched on, and I've heard him speak on before, about how the industry is changing. You've got a lot less graduation into accounting. You've got a lot less people taking the CPA exam. And then his predictions for where the industry is going and where PE is going to take it, and PE is going to be buying up more and more of it, and why that is, and then combine that with what Randy's basically speaking on in general, which is the specialty tax, this advisory role of accounting firms. And I just see these two things kind of coming together, especially in the face of technology. When you think about Mark Andreessen saying, was it 10 years ago now, or over 10 years ago now, that software is eating the world? Well, software's eating, what he means by that is that every single industry is going to be eaten up by software. And accounting is no different. And I think this is one of the biggest changes that I think Allan is kind of intimating is going to happen. I mean, when you have all of these different changes happening, and you've got you're going to have to you're really going to have to move quickly and change things and offer more services and be more of a solutions provider to more clients, and maybe with less people, or getting into the more that you get oriented into technology, maybe you can start drawing some of those people back. Some of these younger people that have grown up with technology, of course they don't want to sit down and do tax returns all day, but they don't mind sitting down and using software to augment an advisory role. So I just want to kind of put everything together like that, before anything else, and just say, I think, really software technology is the answer. Obviously I'm biased. I run a software company, but I think, the writing's on the wall for everyone. And that's not really telling you anything new. I just think that when you look at the power of what Randy's been talking about this last 25 minutes, if you can encompass that kind of thing into software, Randy is, he's been doing this for years. He's someone who has a vast understanding of this kind of advisory, especially tax advisory stuff. But, how are your new people, or how are your, people that have already been in the business for a while and don't know about this stuff, how are they going to integrate this kind of information? Well, you can go and you can look up Randy, and I encourage you to do that. TriMerit is an excellent company. But another way to do that would be to incorporate technology. And I don't know of a way to, and maybe, I've got some other good software ideas, just by listening to him speak. But, you think in the future, you're going to have people that are going to see these issues, and they're going to say, that is a problem waiting to be solved. And I'm going to offer it to the accounting, the accounting industry at large. And it's going to come along. And, so I just wanted to kind of lay that out there.
It's interesting point. I can tell you, over the decades, from the big four accounting firms to various tax advisory firms, they've tried to develop software in-house on everything from transfer pricing to R&D credits. And, going full circle with the transforming of the automation of the tax function, there's lots of PE firms also buying software companies now, and they want to integrate them into some of their portfolios of companies, and also, use that money to market it on a large scale with a go-to-market strategy. Before we go to your first polling question, let me ask you, when you think about accelerated component depreciation deductions, which is what cost segregation is, and thinking about that being around since basically the 1954 tax code, how are you able to develop your end-to-end software solution to automate that cost segregation engineering process? Because there hasn't been a software solution like SegStream until you rolled this out.
Yeah, that's mostly accurate. I mean, there have been other people that have tried, and we don't need to get into the details on that. But I mean, I think, first of all, it kind of speaks to the idea of specialization, especially within technology. And this also speaks to what you talked about earlier. There's other, look, there are companies that make billions of dollars a year in revenue. Why can't they make a software to do this or any other specialty tax thing? Well, I mean, the key lies in this what I was talking about is technology specialization, right? They have their business proposition is audit work, it's advisory, it's tax consult, it's tax, it's all of these, those are their businesses. And of course they're obviously, they found some other niches that they can kind of split into, some in IT, et cetera, consulting. But when you think about it, what is it at the end of the day that is their mission? Where are they pointed at, in the long term? And when you don't have a vision that is centered on one thing, of course they have these business departments, they have their own kind of center and they're going towards them. But if they have a software department that's like, okay, you guys need this type of software, so tell us what your requirements are, et cetera. Blah blah blah. So tell us what your requirements are, and then we're gonna kind of work with you to create the software you need. As one of the projects that we're going to do for all the different departments that we're going to do inside of this, huge company. Well, that software department, they might have really talented developers, they might have very talented even product managers, but at that point, what they're doing is they're saying, okay, this is a project that will be done in the amount of time that's been set for it, and as soon as it's done, we're moving on to the next thing. In fact, we might even be moving on as this is going on. Take a firm like SegStream, and our mission, our vision is to make cost segregation, sort of democratize cost segregation for anyone that knows what depreciation is good for in commercial properties. So when you do that, when you have that singular vision, and you're not splitting your focus, well, guess what? No one's going to beat us at that unless that's their singular focus. And no one else has come along to do that yet. And, maybe one day they will. And I imagine they will, if we're successful as I believe we will be, then absolutely people will come along and they'll do that. But I think the important thing to realize is that, it's very difficult to split your focus when your main business is this thing. Oh, I'm doing tax advisory. And then you're like, oh, and also we're going to get this software developed to do that. Well, it's always an afterthought at that point. So it's just difficult to get this kind of software made, at least optimally, right? Like, so to make something that's really usable, that your employees are going to say, wow, like this doesn't just work, this transforms the entire workflow. Like this transforms doing this work. It actually makes it enjoyable, right? Imagine, right? So you're going from, like you mentioned the guy earlier, or Allan mentioned earlier, I'm not going to sit around here and do 1,500 of these tax returns. But when you talk about somebody who's offered an advisory role, who's on the phone with clients all the time, and they're basically just spreading the good news. Hey, as Randy said, I'm pulling this money out of the air and I'm putting it in your pocket. And then they have the tools that don't make them, it doesn't require them to go in and be like, oh, I'm going to, grind and grind and grind for days to get these answers. Even if it's not them, even if it's someone else, the more that you, the closer you can get to, okay, hey, you've got all these tools at your disposal, our people, you say to your employees, and look, go out and not just, sell this work, but promote this work, in the communities and amongst your network. and it's going to be something that people are excited about because they have this technology driving it. That's not like, what a slog I'm going to have to do after this, right? The selling would be the easy part in that case, right? Where you're like, okay, I can easily sell this because it's a great benefit, but then like the work that comes in behind it is just daunting. Well, I see a future where that's not the case, with all of these, these different software solutions that are going to kind of eat up every different little piece. You're going to have all these pieces, you're going to have all these bullets in your gun, and you're going to be like, wow, this is a well-oiled machine. So I'll just leave that at that.
No, that's fantastic. I know Oppie just launched the first poll question, and we're trying to determine from our attendees how they're currently offering cost segregation services to their clients. And it looks like we've got everyone answered. And Richard, you can see the screen, right? It looks like the numbers are still changing.
I can't see the results.
Okay, I can see the results, and right now it's looking like 38% are currently outsourcing it, and 27% are doing it in-house, which is a much higher percentage that I thought would be doing in-house. When you think of the number of accounting firms across the country, Allan can attest to this. There's literally 46,000 plus accounting firms across the country. And even accountants aren't even that familiar with those outside of the top 100 or the top 400 firms. When you think about the size of the accounting firms that generally do this type of work in-house, it's really just basically the top 10 to top 25 firms. There's a handful of top 100 firms that do it in-house, but most co-source or outsource at that point, let alone the much smaller firms, a top 500 firm, a top 1,000 firm, a top 10,000 firm. So I thought that was pretty high.
I'm finding that that's not such an outlier, really. I mean, Peter, many of my clients will fit in all of those different categories. I'm finding that people are getting value of it at almost every level. And I have people in the top 20, I have firms in the top 25, and I have firms in the top, in the last 5,000 of whatever, 46,000 probably. So,
Sure.
that's not a huge surprise to me, but I mean, I think it just speaks to the idea that, look, technology is something that gets adopted, not linearly. It's like, it's non-linear. You get the people that see that see the benefit, and those are the people that are really going to go after it. And it really doesn't matter, what level they're at when they start, but it really matters where they end up when they finish. Maybe that, top, that last 5,000 firms going to end up in the top 100 because, they're forward looking and they're like, oh, I see the writing on the wall. I see that we can get this R&D solution, and we can get this cost seg solution, and we can get this for, 45L, or we can bring on the right people too, because they're growing and they're integrating technology, and they're catching the attention of these younger people. These people are coming in, and also they're keeping their costs low. I mean, think about like when your profit margin is going to go up just because, you're not having to pay, the most expensive employees either. That's just a whole other aspect of this.
Sure. What types of firms are you seeing that are currently using your software? Are they a combination, I would assume, of accounting firms as well as those tax advisory firms?
Yeah, I mean, that just gets back to what I was speaking about earlier. Is just now is like, I've seen from people that have 5 clients who need cost seg, all the way up to people that have 500, 600, almost 1,000 jobs, that are using the software. So you get, when you get into that paradigm, you're really seeing a wide variety. And when you talk about, okay, is it specialty tax, or is it accountants, is it accounting firms that just have as a department? I have all of those different entities as clients right now.
Outstanding. We have a question here from the audience saying, what does the IRS think of an application like the SegStream software for cost segregation?
No, that's a great question. So that's a question I've been answering more and more. And there's a long answer to that question, but I think the short answer is that the IRS is not really in the they're not really in the business of evaluating software programs they're in the business of evaluating tax returns, right? So if you're, what you really need to worry about is if you're using a piece of software to generate something that you're going to put in a tax return to generate a piece of data or many pieces of data, the important thing is to realize, hey, when the rubber meets the road, does this tax return and does the substantiation of this tax return, any kind of reporting that comes in behind it, and just in case of audit, is that going to meet with the audit techniques guide for whatever it is? In this case, cost segregation, is that going to meet with a high quality study under the audit techniques guide? And with SegStream, I absolutely believe it does, because I've been doing it this way since I started in cost segregation with Ernst & Morris since 2005. So I know that's just throwing that name out there. I mean, they're one of the first people to ever do cost segregation outside the Big Four. So I feel like we definitely had some of the pioneers in the industry there, and they came right out of Anderson in the 80s. So there was always this really strict adherence to a set of principles that meshed the engineering with the accounting rules, and those are the principles with which SegStream has been developed. So yes, in my opinion, I mean, like the long answer there is that, yeah, I mean, the IRS is never going to come out and say, yeah, I wish they would. I kind of actually, the first time somebody asked that question, that was my first answer, was like, I really wish that they would come out and say, hey, does this meet, is this a software that allows, cost segregation to be done at the highest quality, and if they had some sort of standard that we could meet, hey, great. I'd love to put IRS approved stamp on it, but I don't see that happening anytime soon. That doesn't mean it can't. But I will continue to lobby the IRS to get approved if we can.
Outstanding. And how can people contact you, Richard, if they want to? And I'm encouraging the attendees, if they are doing cost segregation in-house or they're planning to bring it in-house, to get a complimentary consultation to really understand the scope and application of your end-to-end software solution. Because again, when you automate a process, you are inherently reducing risk. Again, I'll dummy it down to everyone. Would you rather do a tax return using Go systems, Pro systems, UltraTax, or would you rather do it pencil and paper with depreciation guides out, tax tables guides out, instructions to different schedules? There's so many different ways that can go off the tracks. So I encourage everyone to automate.
Peter, that's a great point. Let me just touch on that really quick. I have engineers and architects on the payroll. Their only job, they do not sell cost segregation. They do not do cost segregation. The only thing they do is develop models to automate cost segregation. And what are the guiding principles behind that? It's the audit techniques guide. How are we going to make these the most compliant? If your team has to worry about that on top of managing some sort of like really sort of unwieldy software like Microsoft Excel ported into Access or using some sort of macros, that's a huge burden. And I always remember, I'll never forget the feeling of angst when I turn in a project and be like, I think everything looks good in here, but I'm not sure. Well, SegStream is like, with cost segregation, we want you to put your faith in us and say, hey, that's all we're doing. We are doing nothing else but completing cost segregation studies and developing these models and iterating on them and making them better. And the entire point is we're that software team that you can't afford if you had to bring them in-house. If you had to have a department of software, PwC can do it, right? Deloitte can do it, but they're still not going to be as good as us. Why? Because they're split focused. But even if you could take it in-house and say, oh, we're going to do this and we're going to develop our own software, you're splitting your focus. You need to worry about your clients. You need to worry about all the other services you're offering. You can't just focus on cost segregation. That's all we do. That we want to be that for you. So just remember, like when you're worried, hey, are we putting out the highest quality product every single time? That's all I'm worried about, which is kind of the point of SegStream. So with that, let me just share my. I do want to share a short video if I could. It's like 30 seconds long, just
Sure,
to show
please.
you kind of. Can you? Oh, sorry. Let me share my screen. Share sound. Okay, you guys see that?
Yes.
All right, excellent. So, play.
Just choose the module that corresponds to your property type. Now we see the inside of modules.
Should have set this up better. Yeah. So this is just a very quickly edited version of what happens in real time with SegStream. So this is not the actual speed, but it kind of just catches the just for brevity's sake. I've just cut it down really short. So this is how SegStream works.
Just choose the module that corresponds to your property type. Now we see the inside of modules, a simple form questionnaire. Once you've scrolled through and responded to each question, you'll see the submit button here. Now that you've submitted your responses, we're working hard behind the scenes. When we arrive at the worksheet, you'll notice that all the work is done. We've used the property characteristics you've provided combined with our own cost segregation expertise to generate a fully custom property from RS Means building components, pre-segregated by maker's recovery period. Creating a report couldn't be simpler. Just click Export to get a cost seg study with your firm's existing custom report format at the click of a button, directly from SegStream. That's it though. In the time it took you to get a coffee, you have a custom-built, fully formed cost segregation study in your existing report format.
Okay. So here's my information. And yeah. And if there are any other
Outstanding.
questions, I can't see if there are, but
There is one other question from my friend and colleague, Mark Bernstein. He has, Richard, are you developing Section 179D software as well? And I'll throw that out not only to you, Richard, but also to Randy at Tri-Merit, and of course, Dominic and Mark, who is up next at Sparse Technologies. That's a good question. If anything's being developed on the energy tax incentive side.
and not currently. Is that the only question?
That's the only one.
Okay. Well, this is my
Okay.
info. So thank you, everyone. And I'll leave it to you, Peter.
Thank you very kindly. Appreciate it, Richard. And again, I encourage everyone that is doing cost seg in-house and not outsourcing it to take a look at SegStream, schedule a complimentary consultation, especially as you're trying to determine your staffing needs and how you're mitigating risk going into year end before tax season 2023 kicks off. I'll open it up to Randy, and I'll also open it up
I was
to
going
our
to say
next
one more thing.
speakers.
Even if you are outsourcing it.
Yes.
Sorry.
No worries. No worries.
Yeah.
I'll ask Randy. I know Randy also serves on Intuit's board of directors, and I'll also ask Mark and Dominic if they have any plans to automate this particular area of federal tax credits and incentives. I'm going to assume silence means no. So we'll move to our next topic, which is Dominic. Absolute pleasure to have you on the broadcast. I know you're with Mark Andrus as well. And we have on the line Dominic, who is the Chief Executive Officer, who founded Sparse Technologies, along with Mark Andrus, who's the Chief Revenue Officer. And they built a end-to-end software solution to help identify, gather, and document R&D credit claims. Welcome.
Thank you, Pete.
Yeah, thanks, Pete. Appreciate that.
Absolutely. From the technology you've been developing, it's not just R&D, correct? You've got some other software solutions you're working on as well?
Yeah, that's right, Pete. So now in response to Mark's question, we currently aren't undergoing active development on a Section 179D software. However, we do have our R&D credit product, which is our flagship product. We have an employee retention credit product, which is a product that's fully developed. I actually just finished a study last week with one of our clients using our ERTC product. And we are always in the market to continue innovating and creating new technology. So this is not to say that we will never turn our sights on 179D or other specialty credits, but just to say that, hey, today we're really kind of sticking in our bread and butter, getting our flagship into as many of our clients and as many of our customers' hands as possible.
Fantastic. Okay. You know, when we're talking about the digital transformation era that we're in right now within specialty tax incentives, why do you think these specialty tax credits have lagged behind the technology space until recently?
Yeah. That's a good question. Kind of leads me in, of course, Pete, into something. So let me give a little bit of information and kind of explain that a little bit. There's a couple reasons. One reason is the issue of what Richard just said. What is the gold standard from the IRS? What exactly does the IRS want to see? And then the other side of that is, where was technology, right? How is technology advanced, and is technology at a point when we can actually make something useful? So as a lead into that, let me kind of step back a little bit. Today in our presentation, we're going to talk about something new. We're going to talk about some things that you've never heard before when we talk about R&D credits. And for years, when we've talked about R&D credits, I'm talking, the people on this call, if you're a CPA, if you're a taxpayer, you've heard things like analyzing the R&D credit is very difficult. You've heard that you have to be a specialist to understand all the R&D credit rules. And you've been told that you should really step aside and let the R&D credit experts take care of things. If you're a taxpayer, that means that you're paying a lot of money to the experts. And if you're a CPA that doesn't have a R&D credit team in-house, that means that you're referring revenue to other people and you're just told to step aside and let somebody else do that. So getting back to your point, Pete, why has this not been done before? The things that we've been told, they were accurate maybe in the past, but that's just not the case today because of technology. So technology can do things today, and artificial intelligence can replicate the decisions that professionals have been making. And so with that artificial intelligence technology, with automations, and then the other piece that has really changed the landscape is that the IRS actually has told everybody exactly what they want to see in an R&D credit study. So Richard made a great point. He said, if we had a gold standard, if the IRS would just come out and say, this is what I expect to see in a cost segregation study, then everybody could drive towards that standard. We've had a lot of conversations over the last 30 years with the IRS. And in September of 2021, the IRS actually issued a chief counsel memo and said, this is exactly what we want to see in an R&D credit study. If you do these things, then you're meeting the requirements that we want to see. Now, that includes things like, we want to see the documentation for every project. We want a memo written up for every project. We want to know what every person does and how those people spend time on projects. Now, in the past, a lot of taxpayers don't have time tracking that they need. And in the past, when you're trying to do all of this work manually, it's just too much. That's why we've got the situation we have, I think, with R&D credits in the United States. When I was a staff person and I was writing up a project memo, it would take me, it would probably take 12 to 16 to 20 hours, right? We would budget. For a while in my career, we used to budget $10,000 per project to interview somebody, to write up the project memo, to gather the documents and put those things together. Today, with artificial intelligence, you can do all of that work in a matter of minutes. Artificial intelligence can write the memo. Artificial intelligence can review the documents. Artificial intelligence can map the things together and can assemble a report. But maybe before I get ahead of myself, I should not talk about the technology. I should let Dominic, my business partner, talk about the technology, since he's our chief technology officer and a lot of other things. But the exciting message here, and we've got a lot of information we'd love to share. We'd love to start conversations with you about this. But because of technology and because the IRS has said, this is what we want to see, you can bring those two things together so that any tax professional can do an R&D credit study that is actually probably better quality than what you've been receiving in the past by automating and so forth. So with that, hey, Dominic, I'll just stop talking and you can start talking.
Yeah, no, and I appreciate that, Mark, and Pete, I appreciate you setting the stage. Everybody else coming before us, Richard, Allan, Randy, of course, a lot of great things on today's presentation. There's been a lot of words said about the R&D credit space, right? And the tax space, the accounting firm space as a whole, right? I mean, Allan mentioned a number of times, things are changing. PE is coming in. PE has different demands than the historical model, the incumbent model. And then additionally, the talent, the people in the industry, the young people coming up, even the people that are, young partners or senior managers have a different expectation of what their career is going to look like in 1, 3, 5 years. And the key to this is using technology to advance your practice, right? There's a lot of fear around technology, right? We hear it in some of the questions that we hear in our discussions with the prospects. We hear it even today, hey, well, does the IRS accept software, right? The point I would postulate there is that the IRS doesn't audit software, they audit results, right? So the idea is, hey, the way that you get to the results, it's not like the IRS says, well, let me audit Excel. That has never happened. They audit the results that come out of Excel. And by knowing that, by leveraging that, if you can get to a position quicker, more standard, and a little bit faster. I'm not sure why Richard's sharing our SegStream screen there, but that is Richard's information. On that note, right, the big point of it is that if you can get to a place where, hey, let's file our information, let's get to a position that we're comfortable with, and let's do that via technology. Now, there's a lot of different technologies in the R&D credit space to talk about, right? We have really what we refer to internally as low value tasks, things like requesting client data, manipulating client data, using all that information to make some decisions, right? Or to get it into a place where you can make decisions. Data is complex. It comes in many formats, and tax consultants at accounting firms, as well as taxpayers, can get sidetracked by, well, this client doesn't send these columns or those columns, or, it comes in a bad format and I have to copy and paste. I'll tell you a story. Let's see, 2 weeks ago, right? The big thing here was one of our clients sent us 717, right? They received 717 W-2 PDFs. And this is a client that uses our software. In the past, we asked them, said, hey, what was your process before this? They said, well, typically we'd assign a staff or an intern or a paraprofessional to go through and just copy the name, copy the W-2, the box one wage, copy the stake into an Excel spreadsheet. And now 717 W-2 documents, that would take hours, tens of hours, it could take up to a week depending on availability, especially during the busy season. That's not something that is easy to understand, right? So the big part of that was, hey, how can technology make a difference there? Well, our technology, our SPRX technology for R&D credits, has the ability to OCR W-2 documents in a matter of minutes. So our client loaded up 717 W-2 documents, and about 120 seconds later, they had a structured file. It had all the information from all the W-2 documents. They could then cross-reference, they could do their own professional review. And instead of taking 15 hours, it took a total of maybe 15 minutes. You get the data, you review it, you put it into the software, right? And that's just one example of a potential inordinate amount of time that would be spent on that particular client's data. Now, multiply that if you're a CPA firm by, 150, 200, 300 clients that you might be doing at some of these big firms, you're all of a sudden seeing, well, geez, there's a tangible hours saving in just not having to mess with, data types and structuring and things like that. And I can show you at SPRX, we have two primary ways to get data, right? Connect technology, which connects directly into clients' payrolls and GL systems, as well as a bring your own spreadsheet intelligent import, right? So we have AI that helps you load a spreadsheet up. We walk you through a couple of steps. Next thing you know, your data is in the format that the software needs it, right? So these are tasks that are not necessarily high value, tax advisory tasks. The tasks that Allan and Randy alluded to, these young professionals wanting to be involved in. These are kind of rote practices, the quote unquote, 1500 tax return style practices that people don't want to be involved in, but they consume an inordinately large amount of engagement hours, and that just reduces profitability, reduces satisfaction, and oftentimes, quite frankly, reduces the quality of results. So there's all that. Now, as we go into things like regulatory requirements for the R&D credit, Mark mentioned, the IRS has told us this is what we want to see in an R&D study, right? We put out the chief counsel memo. They said we want to see business component memos per project, right? We want to have documentation, the full suite of documentation analyzed on each project, right? And we have technology internally at SPRX that will allow you to, by uploading a few sentences about a project, a few sentences regarding the project's uncertainty and process of experimentation, that 4-part test Randy talked about, by entering a couple of sentences about that, it will generate a novel memo using AI, NLP, neural networking, and it will give you a memo, 700, 750, 1,000 words about that particular project. So you can go through and perform professional review on memos instead of saying, hey, staff person, manager, senior manager, partner, whoever it is, or internal tax department, you have to write up a memo. As soon as, once you get through your 5th memo, you pretty much know how to do it. And if it gets to become a task that does not, again, contribute heavily to the value of an R&D credit study. And the same thing for documentation. Oftentimes we hear of people who are getting 2 documents for a study, 3 documents for a study. At a firm that we're familiar with, the rule was, well, we need 2 to 3 documents per project, right? And that was an artificial paring down of the requirements, right? It's an artificial reduction because of what professionals are capable of accomplishing. Well, using AI, using documentation AI like we have at SPRX, you can upload 1,000 documents per project. Let's say you're a CPA firm, you're doing a project, you can upload every document they've ever had. Our software will analyze all the documents in any format, and it will tell you, hey, is this a good document? Is this highly persuasive? And if not, what can we do to improve that? So with all of that taken into consideration, the ability to load data quickly using payroll and GL Connect technology or intelligent import, the ability to automatically generate novel project memos near instantaneously, and the ability to analyze every single document. When you roll all that together, all of a sudden you can see, hey, we get from nothing to all the way up to the point where we start exercising our professional review, reviewing some of the items that the AIs made a decision on, talking with our clients much, much faster. We cut out, in our experience and our clients, we can cut out up to 80% of the time spent doing an R&D credit study, whether you're a taxpayer, a CPA that's doing a couple of R&D studies, or you're not doing any studies at all, or you're a large CPA from within established practice. The point is that this can range the gamut. The entire way that the industry operates is changing, right? And it's changing in such a way because technology empowers it. And last but not least, of course, the ability, right, to generate a report for all of this. Now, Mark, you and I have talked at length, and we found that the average time at our client before SPRX to generate a report. Now, a number that can happen pretty quick if you're, plowing 100, 200, 300 hours into it. But the average time for our clients before SPRX to give their clients a report that they then either file with the IRS, put into a file on their shelf, right, was up to 270 days. Why is that? Why is that the standard, right? Why is the standard? Well, hey, here's the number, and then almost a year later, 9 months later, you guys can have the report that actually tells you how we did it. Oftentimes, when that report's delivered, as Allan alluded to, with the Great Resignation, as Pete, you always allude to, a lot of the team members that did that work aren't there anymore, and that's how you start getting upside down with the service. The key here is contemporaneous use of the software, so that you can use the software as a tool to enhance your ability as a professional to create R&D credit satisfaction, R&D credit studies with high quality and high consistency. Again, whether you're a CPA firm with a team already, you're a CPA firm that outsources to another provider, or whether you're a taxpayer on the call saying, hey, I currently pay someone else to do my R&D study, but I'd like to do it in-house. Great, work with us and we can help you get there. Now, with that in mind, Pete, I can pause for any questions that you have, but if not, I do have just a quick little click-through demo to show you, what the software kind of looks like, some of the modules we talked about, and really hammer on and say, hey, here's what you're going to see when you start working with SPRX.
I think that's wonderful to be able to show at a high level a demo. And I just want to point out how powerful this software is, where you're getting the results, you're getting a report. It's on a contemporaneous basis. And when you're thinking about whether you're an accounting firm doing this work in-house, or you're a tax advisory firm doing it on behalf, basically partnering with other accounting firms, think of how if you can finalize the deliverable in a more effective, efficient, productive manner, how you could accelerate your billing and keep the cash flow of your practice going stronger. Because Dominic mentioned a 270-day lag on average. That's a tremendous amount of WIP you're going to have in inventory that you can't bill your clients because they don't have that final deliverable yet. So again, automating the process is critical. Thank you, Dominic.
Yeah, no, absolutely, Pete. And that's, just a great thing to point out, right? Automating the process is really that. And something that you just hit on, Pete, that's really important is the ability to manage the risk involved in a study, right? So as I know a number of people on the call have seen, a number of our clients have seen, something that they really love is internally, since we have all of this data, we have all this information, we can use an algorithm we've created internally at SPRX to tell you how risky it is, your credit is in terms of an exam with the IRS. Now, again, It's based on, industry, number of employees, size of the credit, documentation, requirements and quality. But most importantly, right, it's another tool for you as a professional to then go and say, hey, SPRX is saying this is a low risk study. We understand that. We agree this is a low risk study. Or it might say, hey, SPRX risk, risk meter, risk gauge is showing medium here. That makes sense because, it's a small biotech company. Even though it has a huge credit, it only has, 5 or 6 employees, right? There's a lot of capability there for you then as a professional to use your judgment, to use your capability to say, hey, this is fine. Or, well, geez, I thought this was a low risk study. Why is this coming up medium? Well, you can look in our software. We can help you understand why that would be happening and what you can do to augment and enhance your study's documentation to make sure that you get that down to that low risk category. Now, with that in mind, time to jump into this little software demo here. What you're seeing here is your home screen. You're doing your R&D engagement. You're presented with these 6 cards. The first step in the process, it's a taxpayer profile. Really easy. You put in the name of the entity, you put in some information, elections, methodology, things of that nature. Anybody can do this, paraprofessionals, interns, staff people, or if you're a taxpayer, somebody in your staff accounting department, right? If you have a accounting department or a tax department, get somebody in here to fill out your taxpayer profile, right? Additionally, after you do that, you can go to your data upload. As we mentioned, any team member can access this. So you can do it piecemeal, you can do it all at once, you can do it however works in your workflow. Like I mentioned, we have 2 primary ways: Connect technology, Payroll Connect, or Intelligent Import. And with Payroll Connect, if you're a provider and you have credentials into a payroll system, great, enter them right here on our site. We'll go in, we'll grab the information that we need for R&D credit, and we'll disconnect. No risk for data monitoring or anything like that. However, if you're a provider, if you're a CPA firm or anybody who doesn't have payroll credentials, we can just send this to your client. Send them a link, type in their email and their name. It'll send them a single-use link. They can do the same thing. Again, very powerful. And if you say, well, geez, our company, if you're a taxpayer, say our company is not really into technology and integrations and API. They just want to, take the report from SAP or from ADP and use Intelligent Import. Great. Bring your own spreadsheet. Any type of spreadsheet, as long as it has columns and rows, we will work with our AI. Our software will work with you to get it in the format that we need. After you do that, really easy. You can put in some state information, but you hit the calculate button and you get instant results, right? You can see our AI will predict qualifying percentages based on all the information that you put in already, or you can enter those at the time of upload. But here you can see everybody. You can see all of the information. You can make micro adjustments here in the software. You can download this to Excel if you're more comfortable in that tool and make adjustments in Excel and then re-upload them to the software. And then once that's finished, right? You review, you validate, you can send this to a client via an SME survey. You can see all your documentation up here at the top. You can even allocate costs. The AI will automatically allocate costs for you originally, and you can make micro adjustments to that as well. Or, hey, say, but listen, I did all this work. I did some analysis. I need to send this to my client. Great. Send it off to your client. They can go through the same exact workflow that you're seeing here, of course, with some information stripped out. The key here is that you're still the expert. You're reviewing, you're validating each component of the credit. And then finally, as I mentioned, it's super quick and easy. That's the whole thing. That's the software. You generate the tax forms, you generate QRE schedules, you generate a full executive report, and you can get in and out of a study as quick as 90 minutes, right? We just worked with a client a couple of weeks back, and they called, a client of our client called them and said, hey, it is the Thursday before 9:15. Our old provider for R&D credit purposes, they kind of waffled on us, right? They're no longer around. We need an R&D credit. Well, using our software, we were able to get information Friday morning for that credit, and we were delivering a report on Saturday afternoon, less than 24 hours later. So the point here is that we need to supercharge our processes using technology. We can't be afraid of technology, right? The industry is changing. The superstars don't want to work on mundane work anymore, like Allan said, and they don't want to be doing the same thing over and over again to hopefully, make partner in 10 years, or hopefully make VP of tax in 10, 15 years, right? The key here is that we as an industry need to embrace technology, and we need to continue embracing technology in every respect. Now, with that in mind, I am going to just send a quick message out to all of our hosts and panelists. It is our, not our hosts and panelists, to everybody. It's our link to schedule a meeting with our team. It's a complimentary demonstration. It's a complimentary discussion with us. We are happy to talk about how we can best use SPRX at your CPA firm, whether you have a team right now, or whether you're outsourcing to somebody else, or if you're a taxpayer and say, hey, I want to do my R&D credit myself, or I want to do parts of my R&D credit myself. Great, let's talk. let's figure out a way to work together. And most importantly, let's figure out a way to continue innovating the industry. And of course, last but not least, I put in our link to schedule demo, as well as a link to our website. You can see the walkthrough that I just showed on screen. Right at the top of our website, there's a big old button in red that says see the software. You can click through the exact same screens at your own pace. So don't be afraid if I was going pretty quick. But on that note, I'll pause for any final questions. No, Pete, I know we're coming up on time, so I want to be considerate of everybody.
Sure. No, I appreciate it. I encourage everyone to reach out to both Dominic and Mark, take a look within the chat box to schedule a complimentary demonstration of the software. It could really take your practice to another level through automation. We are looking at really a true paradigm shift in the industry, whether you're looking at automating tax provision reviews with a Thomson Reuters OneSource type of program, or you're looking at the compliance function over the years, specialty tax. It's really important, again, to mitigate risk for your staff, as well as optimize those scales of efficiency to increase effectiveness and productivity in rendering these services. So really critical. We have our next panelists up. From Infinity Globus, we have the founder, Vivek, who founded the Phoenix Institute, as well as Infinity Globus, and building what I'll call a world-class staffing augmentation firm that assists accounting firms all over the United States with everything from tax compliance to accounting advisory services, test services, you name it. Vivek's got the staff with the subject matter expertise to greatly assist. And when you think about the bursting baby boomer bubble in the United States, losing so many great thought leaders all at once, Allan mentioned at the start of the broadcast, the number of accounting graduates are down in the United States. It's sort of the perfect storm from a staffing perspective here in the States. And when you think about global centers of excellence, and you're thinking about how can we serve our clients properly and have the right team members in place, the wonderful thing, many wonderful things, but the thing that caught my eye when I first met Vivek years ago was the Phoenix Institute, where he actually trains everybody. And maybe, Vivek, you want to talk a little bit about that with the Phoenix Institute, and then how they come to work in Infinity Globus from there.
Yeah, Peter, thank you so much. And hi to everyone here. Regarding the Phoenix Institute, Allan rightly said that the globe is facing the scarcity of the resource, mainly in the accounting industry. And to overcome the staffing issues, the only solution is to bring the youngster or a fresher to the industry, provide them the training, mainly the skill development training, apart from the academic qualification like an enroll agent or a CPA. That is all about the Phoenix Institute. So when we inaugurated and started the Phoenix Institute, we focus on the skills. So practical training course, the practical accounting course, 3-month, 4-month program with the guaranteed placement. So since the inauguration, especially in 2022, the Phoenix has trained around the 500 youngster and the fresher for the US tax and accounting. And those are already placed, okay, in the industry. They are working with our group of the companies as well. They are working with the other companies as well. We place to the large accounting as well. So the solution is to bring the new people, train them, provide them the proper skill courses, and start the employability for them. That is all about the Phoenix Institute, Peter.
Outstanding. Outstanding. I see Amit standing by. Hi, Amit.
Hi, Peter.
Great to see you. One question that we have in the chat box, it says, what is the best co-sourcing and outsourcing process? And maybe you can discuss the differences between an outsource and a co-source relationship.
Sure. So normally people interchange this word co-sourcing and outsourcing, but as there is a difference between these two, outsourcing is, as I understand, it's a short term. People focus kind of a interim need-based solution, and on the other hand, co-sourcing is a kind of partnering, is a long-term solution of a CPA firm with the professional service provider company like Infinity Globus, which focuses developing ongoing long-term relationship. Like you can say sort of consulting, but it's not even consulting, as because it's kind of more of partnering with the CPA firm. It is kind of their just extended office, just physically located halfway the world. So co-sourcing like has helped many companies that don't have the staff capabilities to service their expanding CPA practice. And as the panelists talk about the baby boomer and great resignation that we all know. So this co-sourcing can be a great solution for this scarcity of the accounting professionals that we are facing in this industry. Some of these like diversity of the services that co-sourcing model offers is starting with a basic day-to-day accounting, bookkeeping, and from that tax return preparation to advanced level of specialized skill like inbound, outbound tax planning, tax strategy, then ERTC. So it's not just restricted to small and basic, but it can extend it to any high level of services. And this is how I put in like this difference between co-sourcing and outsourcing.
Outstanding. Outstanding. We've got another question from our panel. What criteria should be taken into account when researching the market and potential strategic partners?
Vivek, would you like to take this question?
Did we lose Vivek?
Yeah, no worries. So as we talk about this co-sourcing and outsourcing, and co-sourcing being, we talk about a long-term solution, it's important the partner as a CPA firm you choose, you take into consideration important aspect, and those few important aspect I would consider is potential of the service provider to deliver strategic value to your organization. And there are like compatible, culturally fit management with your needs. Then you can ask for the references for like from their existing customers to determine their core competencies, and not just based on their marketing, but you actually take the opinion of their existing customer experience that can provide a valuable feedback. You consider the growth potential, because as any business owner, CPF firm would be expanding. So whether they will be able to fulfill, they have that infrastructure in place, and they have that bandwidth in place to cater the growth potentials. So these are the few aspects that one should consider or take into account when they are researching the market and potential strategic partner. Vivek, if you like to add anything to this.
Yeah, Amit, can you repeat the questions because it got disconnected and I connected again?
So the question Peter has is what aspect or criteria one would take into consideration when researching the market and the potential strategic partner?
Okay. Got it. So Peter, basically the first we need to make, if you're planning, I'm audible, right? I mean,
Yes, you are.
yeah. So if you're planning to choose the outsourcing or a co-sourcing partner, first you have to identify your need. What you exactly wanted to outsource. Okay. You can outsource anything. Okay, bookkeeping, payroll, high level tax services, advisory. So you have to make the first the list what you wanted to outsource, then choose the partner based on the expertise. Okay, if I talk about the Infinity Globus, people are choosing the Infinity Globus because we support from the lower level to the all the way high level services with the specialized services, IRS tax resolution, backyard filing, salt, multi-state, ERTC kind of the stuff, business valuation, audit and attestation, SEC filing. So first identify your need. Based on that, see the capability and the expertise on the subject matter. If I give the simple example, when I met someone in the Vegas, or can you ask about the our capacity to handle the higher level tax return, and I discuss maybe 10 or 15 minutes. And immediately after the AICP engage event, sometime in the August, he just called me that the Vivek, I got the very good opportunity to buy the practice with the attractive valuation because they are short of the staffing and they can't deliver the 2000 tax return, pending 2000 tax since you committed that you can perform the task, right? And the 2000 tax return in just September and October 2 months, we just delivered. Okay, so you have to choose the right partner based on their capabilities. Since we have our Phoenix Institute, our training academy, we can offer the more staffing and the expedite staffing solution. So that is the one criteria I think, and also the small other stuff, the data security, the easiness to work. Okay, there are a lot of standards available for the data security like a SOC 2 compliant and so many stuff. You have to verify all those, but I think that the capability and the expertise on the subject matter is very, very important while choosing the outsourcing or co-sourcing partner. Peter.
Outstanding. And I know both of you have served in the past for very large accounting firms, BDO, MBAF, ERE, the largest of global firms. And I know you understand how to be planning out the actual staffing schedules. And this is really a perfect time as we're going towards year end for our clients. I encourage the attendees to think about the staffing at their respective firms and think about, do they need assistance and in what service lines and at what levels? Because of the staffing shortages in the state, I think the more people embrace global centers of excellence, it's going to be seamless client service. And looking at historically the outsourcing model, if you went back to the 1990s in this country, back then it was the big six accounting firms, right? They became the big five the summer of 1998 when Price Waterhouse merged with C&L. And then, of course, Arthur Andersen's demise, the summer of 2002, 20 years ago, became the big four. But if you went back 20, 25 years, it was really just the big four. You want to call it the big six. You might have had Grant, McGladrey, and obviously BDO starting to embrace that model. But if you fast forward to today, you see many of the top 100, many of the top 200, many of the top 300 accounting firms embracing this and figuring out what is the best way to serve our clients. What has your experience been over the last few years? And I know you've recently, and congratulations on acquiring several firms here in the States as well. What has your experience been as far as the size of the firms that you collaborate with?
Yeah, Amit,
Okay.
you want to answer?
Yeah, let me take this question. So basically, when it comes to co-sourcing or outsourcing the services, what happens, it's not just a big 10 or 50 or 100 accounting firms. I totally look at it other way. Like a big firm will have all the specialized knowledge, skilled person in-house. But on the other hand, the small and mid-sized firm may not be able to afford to keep all these specialized skilled professional in all these areas in-house. And by outsourcing or co-sourcing their needs with the partnering to a like firm like Infinity Globus, they can get the benefit of their specialized skill and knowledge without committing them for full-time employment or at a high level. So say just for an example, say small and mid-sized CPA firm, I'm giving very basic example, say has in-house full-time bookkeeper, and they don't have full-time tax personnel, and they have a client who wants to utilize them for tax services, and they can keep in-house bookkeeping and they can outsource the tax services. We can just expand the same example. They have the tax professional as well, but say they receive a client who have this all inbound and outbound, say guilty and everything complex client. And because they don't have the in-house capability to cater this specialized knowledge, they can outsource such specialized work that SALT or ERTC or such international tax planning strategies and everything. So what I think is absolutely different, like it's not a big firm, it's a small and mid-sized firm who can benefit more by utilizing this co-sourcing model.
Outstanding. Got another question here in the chat panel. That why should companies pick India over other nations for their outsourcing or co-sourcing needs?
Peter, there are a lot many.
Peter.
Yeah,
Peter.
yeah, take it.
Yeah. So there are the reasons. Okay, Peter. India is claiming the highest fresher or a graduate joining the accounting industry. Also, the lot of potential with the India as far as the communication is concerned. You don't believe, okay? This industry has been started almost 22 years ago, okay? In sometime in 2001 and 2002, when me and Amit just joined this industry as a fresher. So this industry is now 20 years old as far as the India is concerned, especially on the US taxation. So if you are looking for the all kind of the services, including the not only restricted to the bookkeeping, but the taxation service, the advisory, the IRS resolution, the attestation, business valuation, the forensic accounting, I must say that the India is the only solution. Okay. So that is the reason that the most of the tax and accounting work have been outsourced to the India with the passage of the time in 20 years. Okay. This industry created a good database as far as the staffing is concerned. Also, the Indian Chartered Accountant, okay, the accountancy exam in the India, okay, is very, very tough. So all the Indian Chartered Accountants are having a great potential, great IQ skill. So I think that that is the reason the people are looking for the India, and just adding the is concerned, yes, I must agree with Amit that this is more about the small and the mid-level accounting firm. large accounting firm since last 20 years having their captive units in the India, okay, and they have a large offices in India, and that might be one of the reasons they are acquiring a lot of firms, small firms in the US because of their backbone support by the India, okay. So India is the, I think that the only solution if you are looking for the all the services and the high level services, Peter.
Yeah, and to add to a couple of things to what Vivek said, like market research report has shown that like close to 80% of US outsourcing companies consider India as their most preferred partner. So that is one of the report that you can see like why India is the most preferred choice. Other than that, being a time zone, we have work on so many tasks where like because of the time differences, you in US work in your day, at the end of evening you send over the work here, and India office works in your night. So effectively your office works 24/7, and that can give a lot of mileage to your practice and increase your productivity. Other than that, technology efficiency, the Indian government is spending heavily on the technology and infrastructure development. Though COVID is the past history and everything, but when that lockdown happened, in just one night, all home were equipped to do the work from home. So that is a kind of infrastructure we have in place. Other than that, with the 1.3 billion people country, with the average age is about 30 years, which makes India one of the youngest population globally. In addition to that, like number of English speaking Indians is more than that of US and United Kingdom even. So these all factors suggest that India is the best choice for anyone who wants to outsource.
I agree. I'd like to also add, when I started my career back in the mid 1990s at Ernst & Young, Ernst & Young was the very first firm back then, 97, it was still the big six. They were the first firm to outsource to India. And within a couple of years, all by 2002, the remaining big four firms all outsourced to India.
Yeah.
And then from there, the Grants, the McGladrys, the BDOs started to explore that. And like I said, now you're seeing firms of all sizes, some that are top 1,000s, top 2,000, top 10,000. There's over 46,000 accounting firms across the United States. People don't realize that. People are only familiar with maybe some of the names on the top 100 listing, but there's over 46,000 accounting firms. And there's firms of all sizes that can benefit from having a strategic partner that can help them meet their client needs. So I encourage our attendees, if they do have staffing issues, to reach out to Vivek, to reach out to Amit, and have a discussion around what your needs are, what service line. Is it on the accounting advisory side? Is it on the tax side? Is it on the attest side? What levels? Is it more of a staff level, a senior associate, a manager? And you do specialty tax work as well. I know you do employee retention tax credit work and other types of work as well. So your subject matter expertise of your team is amazing. Are you up to now, are you close to 400 people now?
Yeah, Peter, we are almost close to the 400 people, and by December 2022, we are adding around 100 to 200 people. And the good thing is that Peter, especially we have a now team around 100 people for ERTC, and we are claiming the pioneer as far as the ERTC filing is concerned. Because we started this exercise with the old level of the analysis, shutdown analysis, supply time disturbance, very detailed analysis. So yes, 400 and the specialized team around the 100 for the ERTC. and we are adding the most probably the 200 people by December 2022.
Outstanding. Outstanding. I want to wish you and your team a very happy Diwali coming up, and a couple that's coming up on Monday, right?
Yeah.
Yes.
Next Monday it will be Diwali, and the New Year is for the Indian rule. Okay, so yeah, thank you so much for visiting.
Absolutely. Thank you. I want to thank all of our esteemed panelists for their insights on today's broadcast. I want to thank our attendees for the privilege of their time. It's with our gratitude to be able to provide this platform to everyone in the community. If there's any closing comments that any of our esteemed panelists would like to end with, feel free to the platform is yours.
Yeah, thank you so much for everyone, and thanks Peter for all your support. Okay, and nicely handled the entire webinar. It's very, very informative. Okay, and the points which put by the Allan regarding the future trend and the private equity and the research and development credit and the cost segregation. So I think that's the very, very informative to all our users. Thank you so much, Peter.
You're most welcome. Thank you.
Thanks,
I
Peter.
think Allan was going to say something, if I'm not mistaken.
Yeah.
Just going to echo Peter. I just want to thank, I know you put a lot of this together and you are like to perfection. So all of us that are your guests today sit in a lot of these calls and a lot of webinars and podcasts. And with you, it just flows so great. And you ask great questions and your preparation is amazing. So thank you from all of us.
Thank you, Allan.
Yeah.
Greatly
Thank you so much.
appreciate it.
Yeah, thanks.
Thank you everyone.
Thank you, Peter.
Thank you.
Okay, thank you so much.
Here, everyone.
Yeah.
Enjoy. Bye-bye.